Hello friends, welcome back to Silver Rewind. Gold and silver just crashed, and the speed shocked investors everywhere. Traders were confused, unsure what was happening. Headlines rushed to call it just another market correction. But this was far from normal. Prices fell faster than most experts expected, wiping out gains in minutes. If you blinked, you would have missed it. Safe haven assets, the very metals people rely on during crises, were suddenly under attack. Something unusual was happening. Something deliberate. This wasn't a random market event. It had signs of planning behind it. The timing of this crash is what makes it even more suspicious. Inflation is rising, debt levels are at historic highs. Investors were already searching for stability. Normally, gold and silver act as shields in these moments, rising while currencies weaken. But instead, prices collapsed, as if someone had flipped a switch. This is not how markets behave naturally. Large, sudden drops like this require enormous selling pressure. Pressure retail investors cannot create. Only institutions, central banks, or large traders with advanced systems could push markets this hard, this fast. The crash wasn't accidental. It was engineered. Media narratives try to make sense of these sudden drops, focusing on interest rates or the strength of the dollar. But these explanations don't explain the speed or scale of the sell-off. Billions of dollars in paper gold and silver contracts were dumped instantly. Physical demand remained strong, yet prices fell. This is a classic sign of market manipulation. Futures and paper markets allow a few players to control massive amounts of gold and silver. When they act, retail investors panic. Fear spreads. Automated trading systems kick in. The result, a perfect storm of engineered chaos. And that's exactly what we saw. For anyone watching, this moment is critical. Understanding that this crash was planned changes how you should react. Panic only benefits those who designed it. History shows that engineered sell-offs often occur just before major financial shifts. They shake weak hands, create fear, and allow big players to accumulate assets at lower prices. If you know this, you don't need to sell in fear. You can prepare instead. Recognize the signs, stay calm, and focus on long-term strategy. This crash was no accident, and knowing that could protect your wealth in the months ahead. Gold and silver have played a critical role in every major financial crisis in history. They are not just commodities, they are monetary assets. For thousands of years, gold has been a store of value when paper money failed. Silver has acted as both money and an industrial metal. When trust in governments, banks, and currencies weakens, investors move toward precious metals. This is why gold is called a safe haven asset. It does not depend on any central authority. It cannot be printed. It cannot be defaulted on. During inflation, gold protects purchasing power. During recessions, it preserves wealth. This is exactly why gold and silver are closely watched by central banks and financial institutions. In times of crisis, precious metals send signals. Rising gold prices often indicate falling confidence in fiat currencies. When inflation accelerates, real yields turn negative. Cash loses value. Bonds become risky. Stocks become volatile. In these conditions, gold and silver usually rise. This is basic market behavior. That is why sudden precious metals crashes during unstable economic periods stand out. They interrupt the signal. They hide stress in the financial system. Governments and central banks rely on confidence to function. If gold prices surge, it exposes monetary weakness. It shows that inflation is not under control. Suppressing precious metals prices helps maintain the illusion of stability. Silver plays a unique role that many investors overlook. It is both a monetary metal and a critical industrial resource. Silver is essential for solar panels, electric vehicles, medical devices, and electronics. As green energy demand grows, silver demand increases. At the same time, silver supply growth is limited. Unlike gold, most silver is consumed, not stored. This creates long-term pressure on the silver market. When silver prices crash despite rising industrial demand, it signals artificial price pressure. Natural markets respond to supply and demand. Artificial markets respond to leverage and control. This is why silver price suppression is discussed so often by analysts. Because gold and silver reflect financial truth, they are often managed aggressively. Price volatility discourages new investors. Sharp drops shake confidence. Many people assume precious metals are outdated or risky. This benefits the current monetary system. Fiat currencies survive on trust. Debt-based systems require belief. Gold and silver threaten that belief by existing outside the system. That is why every major crisis includes an attack on precious metals prices before deeper problems surface. Understanding their importance helps viewers see beyond short-term price action. Gold and silver are not about fast profits, they are about long-term financial survival. The timing of the gold and silver crash raises serious red flags. This was not a random market move. Prices collapsed at a moment when global economic pressure was already intense. Inflation remained high across major economies. Government debt reached historic levels. Banking systems faced growing stress. Investors were actively searching for inflation hedges and safe haven assets. Under these conditions, precious metals normally gained strength. Instead, gold and silver were driven sharply lower. This contradiction is impossible to ignore. Market behavior must align with economic reality. When it does not, outside intervention is usually involved. Timing reveals intention more clearly than headlines ever will. The crash occurred when confidence in central bank policy was fragile. Interest rate hikes were slowing economic growth. At the same time, governments could not afford much higher rates due to debt servicing costs. This created a policy trap. Central banks needed inflation to appear under control. Rising gold prices would signal the opposite. Gold is often seen as a real-time indicator of monetary failure. If gold rises too fast, it exposes currency weakness. Suppressing gold prices during this period helped support the narrative that inflation was temporary and manageable. This is why the crash happened when it did, not months earlier or later. Liquidity conditions also played a key role in the timing. Large sell orders were executed during low-volume trading periods. This maximizes price impact. When liquidity is thin, even a small number of contracts can move markets sharply. In this case, the volume was massive. Futures contracts flooded the market within minutes. This overwhelmed buyers and forced prices down rapidly. This tactic has been used repeatedly in commodities markets. It is not designed for profit. It is designed for control. The goal is to reset sentiment, break technical support levels, and trigger automated selling systems. Perfect timing benefits those who plan ahead. After the crash, prices stabilized. Volatility remained high. Fear replaced confidence. Many retail investors exited their positions. This cleared the market of weak holders. Institutions, however, were prepared. They understand these cycles. They wait for engineered sell-offs. Then they slowly accumulate at lower prices. This pattern has repeated across decades. Timing is never accidental in markets driven by leverage and derivatives. When gold and silver fall at the worst possible moment for public confidence, it is a signal. The event was strategic, not natural. Most people believe gold prices are set by physical supply and demand. This is no longer true. Today, gold prices are largely controlled by the paper gold market. Paper gold refers to futures contracts, options, and exchange-traded products that represent gold but are not backed by immediate physical delivery. These instruments trade in volumes far greater than the actual amount of physical gold available. For every ounce of real gold, there are dozens of paper claims. This imbalance allows price discovery to occur in a synthetic market. As a result, gold prices can fall even when physical gold demand is strong. This disconnect is at the core of modern gold price manipulation. When large institutions want to push prices down, they sell paper gold aggressively. These sales happen quickly and in massive size. No physical gold changes hands, yet the price reacts as if real supply has flooded the market. This creates artificial selling pressure. Buyers in the physical market cannot respond fast enough. Mints, refiners, and bullion dealers operate on different timelines. Futures markets move in seconds. This structural advantage gives paper traders control. It explains why gold can crash during periods of strong coin sales, rising central bank purchases, and tight physical supply. The market price reflects leverage, not reality. The same mechanism applies to silver, but with even greater impact. The silver market is much smaller than the gold market. This makes it easier to move. Paper silver contracts can overwhelm real demand instantly. At the same time, silver inventories are limited. Much of the world's silver is used in industrial processes and cannot be recovered. This creates long-term scarcity. Yet paper markets ignore this fact. They focus on short-term price movements driven by speculative trading. When silver prices crash despite rising industrial demand, it confirms the dominance of paper pricing over physical fundamentals. Understanding the difference between paper gold and real gold is essential for investors. Paper markets are designed for speed, leverage, and control. Physical metals are about ownership and protection. Price crashes driven by paper selling are often temporary. They create opportunities for those who understand the system. While headlines focus on falling prices, physical buyers often increase their purchases. This silent accumulation does not show up on charts. Over time, the gap between paper prices and physical reality creates tension. When that tension breaks, price adjustments can be sudden and severe. This is why paper-driven crashes should be analyzed carefully, not feared blindly. Large financial institutions have tools that most investors never see. These tools allow them to influence prices without owning the underlying asset. In the gold and silver markets, control is exercised through futures contracts, options, and high-frequency trading systems. Banks and hedge funds can deploy massive sell orders within seconds. These trades are often many times larger than the available physical supply. When executed suddenly, they overwhelm the market. Prices fall rapidly. This creates the appearance of a natural sell-off. In reality, it is a liquidity shock caused by concentrated power. Retail investors cannot compete with this scale or speed. Algorithms play a critical role in price control. Modern markets are driven by automated trading systems that respond to price levels, volume spikes, and technical signals. When institutions push prices below key support levels, algorithms trigger additional selling. This creates a cascade effect. Stop-loss orders are activated. Margin calls force liquidation. Fear spreads quickly across trading platforms. What started as a targeted sell order becomes a full market drop. This process is efficient and repeatable. It allows price suppression to occur without public coordination. The system enforces the move automatically once the first push is made. Institutions benefit from this volatility. Sharp drops create liquidity. Liquidity allows large players to enter or exit positions quietly after the damage is done. Once prices fall and selling pressure exhausts itself, the same institutions can buy back contracts at lower prices. This is not speculation. It is strategic positioning. Regulatory fines issued in past market manipulation cases confirm that this behavior exists. Precious metals markets have been cited multiple times for spoofing and coordinated trading activity. These are not theories. They are documented practices that shape short-term price action. For the average investor, understanding institutional behavior changes perspective. Price crashes are not always signals of weakness. Sometimes they are signs of control. When gold and silver prices fall sharply without changes in fundamentals, it often reflects institutional intervention. This is why emotional reactions are costly. Institutions rely on panic selling to complete their strategies. Long-term trends are shaped by supply, demand, and monetary policy. Short-term movements are shaped by leverage and power. Recognizing this difference allows investors to step back and evaluate events calmly instead of reacting to engineered fear. Silver is one of the most misunderstood assets in the financial world. Unlike gold, silver has a much smaller market size. This makes it more volatile and easier to manipulate. A relatively small amount of capital can move silver prices dramatically. This vulnerability attracts aggressive trading strategies. When silver prices crash, the moves are often sharper and faster than gold. This is not because silver is weaker. It is because the structure of the silver market allows greater price swings. Understanding this helps explain why silver often falls harder during engineered sell-offs. Silver's dual role adds to its complexity. It is both a monetary metal and an industrial commodity. More than half of annual silver demand comes from industrial use. Solar panels, electric vehicles, medical equipment, and electronics all depend on silver. As global technology and renewable energy expand, silver demand continues to rise. At the same time, silver mine supply grows slowly. Many silver mines are byproducts of other metals, limiting production flexibility. This creates a long-term supply challenge. When prices fall despite these fundamentals, it signals artificial pressure rather than real market weakness. Paper silver markets amplify silver's vulnerability. Futures contracts allow traders to control large amounts of silver with very little capital. This leverage magnifies price movements. When large institutions dump paper silver contracts, the impact is immediate. Physical buyers cannot absorb the shock. Silver inventories on exchanges are limited and often rehypothecated. This means the same silver may back multiple claims. When confidence drops, the system becomes fragile. Any disruption in delivery can expose the imbalance between paper promises and real metal. For investors, silver's vulnerability is a double-edged sword. Price crashes can be painful in the short term, but they also create long-term opportunity. Historically, silver recovers strongly after periods of heavy suppression. When monetary stress increases, silver often outperforms gold due to its smaller market and rising industrial demand. Understanding why silver is targeted helps investors remain patient. Volatility does not mean failure. It reflects pressure within the system. Those who understand silver's role are less likely to be shaken out by sudden price moves. Central banks around the world have been quietly buying gold for years. These purchases often go unnoticed by the general public. They do not make headlines because they occur gradually and strategically, yet the volume is substantial. Gold reserves are increased during price drops, not during rallies. This allows central banks to acquire physical gold at lower costs. Unlike retail investors, they are not driven by fear or emotion. Their goal is long-term monetary security. Gold acts as a hedge against inflation, currency devaluation, and geopolitical risk. Accumulation by central banks signals that they expect turbulence ahead. Historically, central bank gold buying tends to accelerate when the financial system shows stress. Countries like China, Russia, and Turkey have increased gold reserves steadily over the past decade. This contrasts with Western banks, which sometimes manipulate gold prices through paper markets. Central banks rarely disclose their strategies in real time. Their actions are calculated to strengthen national reserves quietly. By accumulating during dips, they protect their portfolios while others panic. This demonstrates a hidden layer of market activity that impacts prices globally. Retail investors often misread short-term price movements without realizing the larger strategic picture. Gold accumulation also provides central banks with geopolitical leverage. In times of economic uncertainty, countries with significant gold reserves are less dependent on foreign currencies, like the US dollar. Gold reserves can stabilize national currencies during crises. They provide credibility in international trade and financial negotiations. This explains why gold is treated differently from other commodities. It is not consumed or industrialized. It is strategic. The same paper gold that crashes markets cannot replace the security provided by physical holdings. Central bank purchases strengthen the underlying value of gold over time. For investors, observing central bank activity is critical. When prices fall, it may appear as a market failure. But the reality is that major institutions are quietly buying, while retail investors sell in panic. This sets up a future price correction once market manipulation eases. Recognizing this pattern allows investors to prepare and allocate assets wisely. Precious metals are not just a short-term investment, they are a long-term protection strategy. Central bank steady accumulation reinforces the idea that gold remains one of the safest assets during global instability, regardless of temporary paper market fluctuations. Do not panic when gold and silver prices crash. Sudden drops are designed to trigger fear, not reflect reality. History shows that engineered sell-offs are temporary. Retail investors who react emotionally often sell at the worst possible time. Understanding this is the first step to financial survival. Price movements in the paper market do not always reflect real-world demand. Physical gold and silver continue to hold value. By staying calm, investors can see opportunity instead of fear. Panic leads to losses. Patience creates security. The system rewards those who remain steady. Understanding the system is essential. Paper markets, algorithmic trading, and institutional strategies drive short-term volatility. Retail investors are often misled by headlines or sudden price swings. Knowing how these forces operate allows you to make informed decisions. Recognize that central banks and major institutions accumulate during dips, not during rallies. Price crashes are sometimes strategic, not fundamental. By studying patterns, timing, and market structures, you can separate noise from signals. Knowledge reduces risk. Ignorance amplifies losses. Preparation begins with comprehension. Focus on long-term value, not short-term gains. Precious metals are stores of wealth, not speculative assets. Gold and silver protect against inflation, currency devaluation, and financial instability. Even if prices fluctuate temporarily, physical holdings retain real value. Diversifying with metals strengthens portfolios. Avoid chasing fast profits or reacting to temporary panic. The key is owning assets that preserve wealth over decades. Long-term thinking beats short-term speculation every time. Those who plan for decades, not hours, remain secure when crises arrive. Preparation beats prediction. You cannot know the exact timing of the next crash, but you can prepare for its consequences. Accumulate assets thoughtfully. Monitor markets with calm observation. Maintain liquidity without panic. Understand that engineered price moves are part of a larger financial system strategy. Those who prepare early survive best, while those who wait for perfect timing often suffer losses. The gold and silver crash was no accident. It is a signal to act wisely, not react emotionally. The market rewards knowledge, patience, and discipline. Survival depends on foresight and preparation, not luck.